everyone, I'm Anita Sharma. Welcome to Market Call on BNN Bloomberg. Andrew Moffs is on the program today. He's the Senior Vice President and Portfolio Manager at Vision Capital. He will take your calls, emails, and tweets on real estate stocks. Here's how to get in touch with us. 1-855-326-6266. That is our toll-free number. Our email address, marketcall@bnnbloomberg.ca. Andrew, very good to meet you, sir.
Thanks for having me on the show.
You know what, real estate, a hot topic here on BNN Bloomberg. Folks are fixated with it, whether they're trying to invest, trying to buy their first home, or maybe they're in the flipping business. A lot of questions about how long, specifically the Toronto market, how long it can withstand the highs that once again we're seeing continue to roll in. What are your thoughts?
You know, for us at Vision, the number one thing we care about is supply and demand. It's not location, location, location. It's supply and demand. And so if you think about the Toronto market, we are seeing massive immigration across Canada, particularly employment numbers coming to the Canadian market. What has this meant? Here in Toronto, we have an artificial greenbelt across the city.
Right.
What does that do? There's no new supply of single-family homes. What has that led to? Condos taking share of the market.
Mm-hmm.
And then you think of the demand factors for residential. What do they mean? The ages of 20 to 34, that's when you have your highest propensity to rent.
Right.
And millennials today have that is the leading edge, right, in that cohort today. Great demographics. As a result, we love the rental residential market because those factors, the supply and demand, there's a huge imbalance here in Toronto.
Okay. If we take a look at the REIT index, specifically on the TSX, you would think it's almost trading like an equity right now. That seems to be where everyone is barreling in for now. How long can this continue? Is it as long as interest rates really remain low? And do you see interest rates climbing anytime soon?
Well, it's amazing. If you think back a year ago,
absolutely.
we saw the 10-year U.S. Treasury rate probably almost exactly a year ago, 3.5%. So we've dropped 150 basis points over that period of time. And now, where we were worried about rates going higher, we're worried about rates going lower. Again, at Vision, we're agnostic to rates. You have to think about how do you value real estate. It's not about the denominator, the cap rate, which influences interest rates influence. It's about the numerator, NOI, cash flows. What are the rents? What are the supply and demand characteristics that are influencing those rents? And if you think about what's the number one demand factor, it's jobs.
Right.
So if you have a very positive outlook on jobs for the Canadian economy, that should be good for real estate. It's not about interest rates.
That's a fantastic point. I was reading an analyst report from south of the border, and she basically said, you know what, everyone's talking about a recession just around the corner, but she said, as long as I still keep seeing bullish reports on jobs, specifically south of the border, she's not concerned at all. That's the key indicator that she's keeping an eye on with respect to real estate.
Absolutely. I mean, if you have a job, you can shop in a mall, you
can
rent an apartment, you have a job that takes place in an office building. Those are the key economic drivers for real estate. However, supply always seems to meet that demand. Hence, everything is a cycle. At Vision, that's why we have the ability to go across any market, any sector, and try and find those imbalances. And where we see the imbalance, we'll go along.
Before we started the show, I was picking your brain about another article that I read. It was basically covering an analyst who was with the firm that was famous for The Big Short. And he says now his big concern is climate change. And he says if we do get a housing crash, it's going to be bigger than what we saw in the Great Depression, bigger than '08. And he says it's climate change that's essentially going to destroy the values of coastal homes south of the border. This is bullish, right, for Vision Capital, because you were saying you're focused on the Sun Belt.
Absolutely. Again, jobs. Look at the state of Texas. You look at the city of Houston. That city almost creates more jobs in the whole country of Canada.
Right.
Dallas, Houston, those are key markets for us because why? They're low-cost states, low-tax states. You're seeing a massive influx of immigration to those states. If I take that theme of what should be negative for housing, we think it's very bullish for rental housing. Of course, residential, everyone needs a place to live. And so for the 11 years of existence for our fund, Residential real estate, the apartment space has been our #1 overweight for that reason. They have very defensive characteristics through any cycle.
All right, I was a little distracted at the top of the show. We had a minor technical issue, so if you're going to repeat yourself, I apologize. But I want to know, when we're talking about the bullishness, the fever that once again we're experiencing and seeing in Toronto. I was speaking with Jeff Olin, your colleague, about this, and he said, Anita, Toronto alone is eclipsing jobs growth in the new Silicon Valley. If you combine, what 3 cities? Is it New York, Seattle, and Silicon Valley?
Yeah, the DC markets.
The DC. That's absolutely astounding.
It really is. Say what you want about politics in the United States.
Right.
What has it done? It's if you're a foreign student, if you're a foreign worker looking to move to the United States, the H-1B process to get a visa is incredibly difficult. You can come north of the border and have a job with Google, Facebook, etc. That's done wonders for the office market here in Toronto.
All right, well, we have a job to do, and that's to take our viewers' calls, Andrew. Great start to the show. We'll come back with Andrew Moffs. He's a Senior Vice President and Portfolio Manager at Vision Capital. We're on Real Estate Today, 1-855-326-6266. Welcome back to Market Call on BNN Bloomberg. We're with Andrew Moffs. Let's start with an email, Andrew. This is from Garth in Vancouver. What do you think about Cominar?
So Cominar REIT is a diversified REIT focused on the Quebec markets. Going back to macro fundamentals, the Quebec economy is doing quite well. So if you have a bullish view on Quebec, this is the REIT to own. That said, it's been going through a bit of a strategic change. We really like the new CFO they've put in place as part of that management overhaul. They have a lot of work to do. That has a lot to do with the fact that they have a retail portfolio. Retail today is a tough sector, but they seem fully equipped to deal with it. Where you have a little difficulty in this market today is these companies that have a diversified asset base. They own office, industrial, retail, and it's very difficult for investors to get their hand around the right valuation for a company like that. If you own it today, I think it's a safe hold.
Is Montreal the Toronto of 2016? What's going on here?
Yeah, well, I think it comes down to affordability.
Yeah.
And so if you're a new immigrant, interprovincial migration, you're thinking about where you're going to take that next job.
Yeah.
You need a place to live. It's becoming more expensive here in Toronto. Montreal has become much more attractive for that reason.
Regardless of the language barrier.
Yeah. That risk has seemed to have gone down quite a bit.
All right, Andrew, thank you for that. Let's head to the phones now. You ready?
Yep.
Okay, let's do it. Henry in Hamilton, good day.
Good day. Please, the new kid on the block, European Residential REIT, the management team that has the audacity to take on Europe, do they have the chops to succeed, or are they overreaching? Thank you.
All right, Henry's always colorful.
Thanks, Henry. We like ERE. This is a very interesting company. First of all, management. It's sponsored by Cap REIT, one of the oldest, largest REITs here in Canada. Who, if you think about what does Cap REIT do? They focus on the Ontario market, which is highly regulated. They're about to translate that type of management to the Netherlands, which is a very regulated market. So ERE is focused on apartments in the Netherlands. People don't appreciate that market is one of the most densely populated countries globally, quite frankly. So you have this great demand and supply imbalance where there's no new supply hitting the market. They're able to take regulated apartments and turn them into unregulated apartments. Over half their portfolio today is unregulated. We think there's quite a bit of upside. One last thing, actually, which is quite interesting, when we tour properties, you tour an apartment building today, there's a lot of upkeep, a lot of CapEx that you have to put into these buildings to sustain them. In the Netherlands, you actually don't have to do anything. You don't own the land outside your building. Your residents actually have to take their garbage down to the curb. So high-margin business, we like high-margin businesses, so ERE is a buy.
Who doesn't like a high-margin business? All right, let's get back to the phone. Stephen in Calgary, hello.
Yes, hi there, Anita. First-rate show.
Thank you, sir.
Andrew, I wanted to get your thoughts on InterRent REIT. Management seems to be ahead of the curve with respect to their geographic locations. What do you think of their fundamentals going forward? Thank you.
Thank you, Stephen. Yeah, InterRent.
Yeah. So your callers hit on two things that we like: management and location. Management is highly aligned, very strong. What are they good at doing? Taking buildings and going with a value-add approach where they're able to put capital into their buildings and typically get 15 to 20% returns on that capital, upgrading the suites. Their location all along the 401 here in Canada. Wow. So cities of Ontario, Toronto, Ottawa, and all the way to Montreal. We think there's a lot of upside in this stock. 25 to 30% under rented, meaning the mark to market in their rents is quite high, and that translates to great NOI growth.
Price target raised by National Bank on the 16th of October, $1 to $16.50.
Yeah, that's the great thing about real estate. As the rents go up, so do the target prices.
There you go. What an interesting correlation, right? Let's get back to the phones. Bring in Jim from Toronto. Hi, Jim.
Hi, how are you?
Doing well, sir.
Andrew. Andrew, what's your call on Tricon Capital going forward? Thank you.
Thank you.
Great, so thanks, Jim. So Tricon is an interesting stock. We like this company. We like management. They have a very good board as well. They're in the residential space. They focus on single-family homes for rent in the United States, as well as the apartment business. The apartment business is new for them in terms of going in scale. They just purchased a company from Starlight. As a result, there's been a bit of indigestion in the stock. They have new holders that came in from the Starlight transaction. We saw this as a great buying opportunity, particularly when it traded below $10. The upside in the stock is you could see at least a couple dollars in this in terms of the net asset value.
Okay, Andrew, thank you for that. Let's take a break, regroup, come back to some more calls with Andrew Moffs, Senior Vice President and Portfolio Manager at Vision Capital. We're on real estate stocks, 1-855-326-6266. Welcome back. We're with Andrew Moffs. Back to the phone. Andrew, let's bring in Peter from Vancouver. Hi, Peter.
Hi. BNN is the best source for free education on the market.
Thank you.
We have the great and lovely Anita as the host.
Thank you, Peter.
Andrew, welcome.
Thank you.
And we hope to see you more often on BNN.
You'll be here.
Today, I'd like to ask you about Plaza REIT, PLJ. Thank you very much, Andrew.
My pleasure. So,
lovely.
Plaza Retail REIT, we think highly of the management team there. Michael Zakuta is the CEO. He's very good at what he does. What does he do? He owns and operates and fixes up retail real estate in Eastern Canada.
Okay.
We're not bulls on the retail real estate industry. It's very tough. Vacancies have been persistent ever since Target left Canada, and it's not unique. We're going to have a record year of bankruptcies across globally.
Wow.
That said, they're more of a necessity-based retail focus, more neighborhood shopping with grocery anchored. So it's a hold. If there's a name you want to own in retail, this can be one of them.
So groceries is okay. Anything beyond that?
Yes, I mean general.
You're asking for trouble.
Yeah, general merchandise, anything you can get online. So long as you think that retail sales as a percent of total retail, e-commerce sales as a percent of retail sales continues to climb, yes, you want to avoid those sectors.
Okay, thank you, Andrew. Let's get to Glenn now in Toronto. Hi, Glenn.
Good afternoon. Andrew, what is Vision Capital's current NAV on Morguard? And also, if you could compare it to its sister company, Morguard REIT, for long-term capital appreciation.
Great.
Thanks for your comment.
So just to clarify, I think you might be, the first question might have been about Morguard Corp, the parent company. And it manages two REITs, Morguard REIT and Morguard North American Residential REIT. Morguard Corp, if you're going to own one of the Morguards, that's the name you want to own. Okay. That's the manager. That's where the fees go. That's where the talent lies. In terms of the value, the stock is a $200 stock. Values easily upwards of $300. That said, they are in sectors that we tend to avoid, office and retail, which are both pretty tough sectors to operate in. We talked about retail a little, and office. The types of office buildings they own are going through a bit of a secular change where we all use less and less office space. Morguard REIT, this is the high dividend version of Morguard Corp. Basically, Morguard Corp manages this REIT. It owns office and retail properties across Canada. If you were to look at their same-store NOI, the metric that we look at, it's been negative. It's been negative for quite some time. If whatever the NAV is today, it will likely be lower tomorrow. That's not a type of company we tend to invest in, hence I would sell that.
Okay. All right. Thank you for that. Let's get back to the phones. Bring in John from Toronto. Hi, John.
Yes. Hi, Anita. Anita rocks. Excellent. Anita, thanks so much.
Oh, thank you, John.
Yeah. Andrew, is ZRE a good investment for a TFSA with a decent 4.5% yield? And would you know if their payout is monthly? Appreciate your thoughts, Andrew. Thanks very much.
My pleasure. So this is a ETF that mimics the REIT index. I always caution people that when you buy an ETF or an index, you have to realize what you own. In this case, it's you have to check what are the percentages in terms of is it overweight certain sectors that you necessarily don't want to be in. I believe it's a monthly dividend. I'll be quite honest, we tend to be agnostic about yield at Vision. We're total return investors. You can have months where you lose that whole yield for the year. You should be thinking about, well, what's the value of this REIT tomorrow, going back to that Morguard REIT example. So the ZRE, I think everyone should have a real estate component in their investments. So it's obviously a great way to do that. If you can look for better companies, I'm sure you can do a lot better than the index. And for us, that tends to focus on companies in the residential space or the industrial space.
Okay, let's see if you like this next one then, Andrew. I'll bring in Stephen. Is this Stephen from Vancouver? Hey, Stephen.
Yes. Good morning, Anita. Thank you for taking my question.
Always.
It is on Brookfield Property Partners. I just like to seek your guest view. Sir, is it still too late to get in this stock, Brookfield Property Partners? And may I know what do you think? What kind of future do you think Brookfield Property Partners has? And would you happen, sir, to know the payout ratio? And thank you very much.
My pleasure. First off, Brookfield Property Partners is the global real estate vehicle for Brookfield Asset Management. Very high quality management. That management resides outside of Brookfield Property Partners. They externally manage this. What you're buying when you buy BPY, as we call it, the ticker, you're buying malls and you're buying office buildings primarily, as well as our opportunity fund. The great thing about our space is you have lots of comps. You can compare this company to others. At the present time, you're able to buy BPY to 5.9% cap rate. A cap rate is the valuation metric in real estate. The lower it is, the more valuable it is. This structure has a bunch of corporate governance conflicts within it. It's externally managed. You can go out and buy a pure play mall company today, like Simon Property Group, at a 6.4% cap rate, meaning it's cheaper. You can buy SL Green, the best landlord in New York today, at a 6% cap rate. So what I'm trying to say is there's better vehicles if you want exposure to the type of real estate that Brookfield manages. That said, it's a great management team. And it trades at a very wide discount to net asset value. We just see better outlets to close that gap.
And headline today, stock just moving up 0.5%, but it's teaming up with Drop It to double down on the customer experience and convenience. So it's picking its iconic fashion show retail destination in Vegas to launch this hands-free shopping service. So just innovation after innovation there.
Yeah, you have to find ways for people to go to the mall.
Got to make it exciting, right?
Yeah. So today, 30 to 40% of the mall is focused on necessity-based, whether it's food, whether it's gyms, movie theaters, things you can't do online.
Yeah. What's that big one they're building? Is it in New Jersey? It's going to be the biggest mall with water slides, like a Jurassic Park almost. Okay. Let's get back to the phones and bring in Kathy from Toronto. Hi, Kathy.
Hello. How are you today?
Doing well. How are you?
Very well.
Great.
I own Canadian apartment properties in my RIF, so I'm a little bit disappointed at the dividend yield, but I bought it at 16 and it's now well over 50. So I'm thinking of taking about 25% of it and putting it in BSR Real Estate Investment Trust in the U.S. Does that make sense?
So, Kathy, two things I'd say. You've named two top picks for us at Vision, so you're not going to go wrong either way.
Smart lady.
Yes, and I don't think you should be too upset about that low dividend yield. You've done very well. Again, we care about total returns, and so Cap REIT, notwithstanding the great moves the stock has done, trading around $55 today. I talked about what a tight market we have in Toronto. Toronto's Cap REIT's largest market. We see material NAV growth in this company for many years to come. So when you have a market where 1% vacancy, they can move rents materially. Similarly, BSR REIT, which Kathy mentioned, is a residential landlord in the Sunbelt of the United States. We see a lot of upside in that stock. It is very defensive. And going back to that theme of everyone needs a place to live, we're talking about $800 to $900 rents. We think that bodes very well. This is a stock that we see a lot of upside in.
Okay, Andrew, thank you for that. We have smart viewers here on Market Call. Okay, we'll come back with Andrew Moffs and more on real estate stocks. Give us a call, 1-855-326-6266. Welcome back. Since it is Andrew's first time on Market Call, there really aren't any past picks to preview for you. Instead, or review, I should say, let's take a look at Andrew's philosophy with respect to Vision Capital and how you all, let's face it, try to make money.
Great. So what do we do at Vision? We invest in real estate. Unlike others that buy the bricks and mortar, we buy stocks.
Okay.
Unlike most funds you tend to come across, we operate long and short. So we make bets that the stocks will go up. We make bets that the stocks will go down. Why do we do this? We tend to think like private equity investors. We spend a lot of time on the road touring real estate, understanding the value of the properties. Once we come up with what we call the net asset value, we then compare it to the stock price. If the stock price is trading at a premium, well, here's an opportunity to short the stock, make a bet that the stock price should go down. What we're trying to do more so is to find those stocks trading at a discount. Our goal of Vision is to buy real estate cheaper in the stock market than we can in the private market. Okay, and essentially, you want to help out folks who want to have exposure to the real estate market, but they don't necessarily want to get the call for a leaky toilet or a faucet that's not working, right? So you kind of want them to play through you. Let you or even people through you deal with that nonsense. Absolutely. We always say the best thing about our fund is we have the liquidity. We can go bullish. For example, a few years ago, we went
move quickly
from bullish to bearish in Alberta in 10 days. If you own a bunch of apartment buildings or office buildings, office buildings will take you 10 years to recover your value. So top-down approach, no doubt about that. Let's talk about what you like. I understand you're primarily, but just barely primarily, focused and invested south of the border. What, 60% in the U.S.? Correct. Okay. Yeah. So the great thing about real estate is you can invest thematically. For us, we take a sector approach. So from a top-down perspective, the two sectors that we favor the most are industrial real estate and multifamily apartments, which we've talked about a little bit so far. And we like each of those sectors, both sides of the border. So maybe I'd first touch on industrial. For us, industrial today, industrial warehouse is the new retail. Every negative article you read in the newspaper about the death of the mall is positive for warehouse. If you think about it, if I'm a retailer and I have a warehouse, every square foot I need in that warehouse, if I have omni-channel, if I have e-commerce in my business, I need 3 times the amount of space in a warehouse. Right. Because I'm not dealing efficiently with pallets anymore. I'm dealing with parcels. And then if you think about how do we shop, when you buy something in a store, there's an 8% chance you're going to return it. If you buy something online, there's a 30% chance you're going to return it. All that activity goes through the warehouse. We call that reverse logistics. What this is causing is voracious demand for industrial real estate today by the Amazons, FedExes of the world. Okay. Multifamily, you like that too. What's going on here? We're just going to have warehouses and condos? Is that the new reality? The reality is the lifestyle supports that, right? The smaller your condo, the more, we tend to have this lifestyle where we just want to purchase things, get them quickly the next day, and move on. Residential, very defensive. Obviously, everyone needs a place to live. However, what do we focus a lot on at Vision? We care about the balance sheets, the ability to finance the real estate. Both sides of the border, in the depths of the financial crisis, you had capital available from Fannie and Freddie in the United States, CMHC here in Canada. That's a big deal. Extensions of the residential real estate world for us are manufactured housing.
Right.
Trailer parks, essentially. Purest form of real estate. You provide the land to the homeowner. He or she comes with their prefab home, puts it on your land. They pay land rent. There's no capex requirement. We like that space a lot. There's a couple of REITs in the U.S. that do that. Similarly, another extension is seniors housing here in Canada.
Oh, it's huge.
There's if you think about demographics, you have baby boomers, the leading edge, turn 75 now. There is massive demand for that space. Right now, supply is meeting that demand in certain markets, but we think demographic tailwinds are pretty
You
profound.
think supply is meeting the demand?
In the United States, absolutely.
In Canada, though.
But in Canada,
yeah, it seems to be a bit of an issue.
Only in certain markets here in Canada, and we've done the analysis. And you take a company like Chartwell, only 10% of their portfolio is being affected by above average supply. Even notwithstanding that supply effect, we still think they can have positive same-store NOI growth over the next year.
Okay, Andrew, thank you for that. A little bit of a deep dive into what Vision Capital is all about. Let's take a break and get back to your calls, 1-855-326-6266. Welcome back. We're with Andrew Moffs. Let's get back to the phones, Andrew. We'll get to Marcus in Vancouver. Hey, Marcus.
Hello. My question today is about automotive properties. I'm wondering, are they able to compute, or how do REITs generally activate revenue? I'm just not sure how you go from owning it, but you can't invest in the property, or you can own it.
All right.
You just buy and sell stars on top of it. Thank you.
Okay, thank you.
So APR, they invest in dealerships across Canada. As a result, it's a higher yielding stock. They tend to have very long-term leases with these dealerships. When you invest in a stock like this, you have to think about two things. One, just from a top-down perspective, is this a space you want to be invested in? Do you like the car industry going forward? And there's questions about that they can, if you meet with the company, they can deal with that head on. The other thing you really have to think about when it comes to investing in what we call a net lease company like this, where you have long-term leases, is the credit. In this case, 2/3 of the company is leased to one auto group, so you take on a lot of credit risk. If I as an investor have the ability to underwrite that tenant, I could give a better thought as to how safe this investment is. Unfortunately, it's a private company, so we tend to avoid companies like this where there's too much tenant risk in the portfolio.
Okay, Andrew, thank you. Let's go back to Calgary now and bring in Peter. Hi, Peter.
Hi, great show. Thanks for taking my call.
Thank you, Peter.
I've enjoyed hearing your opinion on real estate south of the border, and I wanted to ask your opinion on American hotel income properties. Specifically, what your opinion of the NAV is there, and is this a yield trap, or is it just really cheap? Thank you.
Good question. Thank you, and Peter.
Yeah, so AHIP is operating in a very difficult space. The hotel space is actually a sector that we are short at Vision. You think about the hotel space in the real estate world, these are the leases that reset every night. And when you're doing that in a world with very low inflation, the metric in the hotel world is RevPAR, revenue per available room. At best, it's going to be flat in the next year, likely negative.
Oh, wow.
So AHIP is operating already in a very tough environment. What makes it even tougher is their balance sheet. They have too much debt, and they don't cover their distribution. So typically, a very high distribution yield is a sign that perhaps it might be a value trap. This is a name I would avoid.
Okay. Thank you, Andrew. David in Toronto has a question. Hi, David.
Yes, good afternoon to both of you.
Good afternoon.
Can Andrew please answer a question or comment I have regarding Artis? I have units in Artis. It's gone down in the last 6-7 years. I guess the Alberta situation hasn't helped. So the question I have is, do I continue to hold, do I buy more, or do I sell?
Okay, thank you.
Yeah, so Artis is a diversified REIT. They are going through a bit of a strategic process recently. They're hoping to, through that strategic process, get values closer to their IFRS valuation in that $14 to $15 range. I'd caution there's probably tax leakage when they try and do this, whether it's selling their retail portfolio, selling an office portfolio, etc. So today, your upside is somewhere around that metric. However, as the caller alluded to, they've been operating in Alberta, and that is a very tough market. They don't have the NOI growth from some of their other markets to offset that. So for us today, Artis is more of a hold than anything. I wouldn't be necessarily jumping into the stock today.
Okay, thank you for that, Andrew. Let's now head to Krista in Toronto. Hi, Krista.
Hi.
Hi, do you have a question?
Oh, yes, I would like to ask about Sienna and what the prospects are in the near 2 years. Thank you so much for taking my call.
Thank you.
So Sienna is a very safe investment. We like Sienna. They operate in the senior space. They operate both retirement homes and nursing homes, primarily here in Ontario as well as British Columbia. When you look at this company, you look at the valuation metrics, and they're pretty, they're very positive. What do I mean by that? One of the largest operators in Quebec got purchased last year by a U.S. REIT named Ventas. They got purchased at a 5.5% cap rate. You apply that metric to Sienna's retirement homes, and you're left with nursing homes. The nursing homes, then the implied cap rate on those are far too high, meaning, what has traditionally been a 7 to 8% cap rate sector should be worth something more in the 6% range. As a result, we think Sienna, which is a $19, $20 stock, could be worth $22 and higher. And at the same time, it's very defensive. You have a very supported distribution yield.
Okay, let's take one more call, Andrew, before we head to break. That would be Mike in Sudbury, Ontario. Hi, Mike.
Good morning, good afternoon, I guess it is. I have a question for you. Question for you, guys, on ELS on the New York Stock Exchange as a holding in a tax-free savings account.
Yeah, so this is a stock we like. We like this sector a lot. It's Pierre Sun Communities is a name that we own in our fund. These companies operate in the MHC sector, the manufactured housing community sector, which I talked about before. Very pure form of cash flow. They simply rent out their land to those that either put their RV or their home on that land. Very defensive.
So that's a growing business?
It's a growing business because, again, you think about supply and demand imbalance. No one in the community wants another trailer park built in their community. Right. So you have a finite amount of communities. At the same time, you have the baby boomer aging. And so these communities tend to tilt more to seniors. So you have a high demand versus low supply. And in the real estate world, where I mentioned, this sector has very low CapEx. There's no hallways, there's no elevators. You don't have to do anything other than just provide electricity and water. This is a sector we really like. It's a growth sector for many years. So I would definitely continue to own equity lifestyles.
All right, great job. Thank you, Andrew. We'll come back with Andrew Moffs, Senior Vice President, Portfolio Manager at Vision Capital. We're on real estate today. Give us a call, 1-855-326-6266. Welcome back to Market Call on BNN Bloomberg. We're with Andrew Moffs. Let's head back to the phones, Andrew. We'll get to Harry in Midland, Ontario. Hi, Harry.
I'd like to ask you about Northwest Healthcare Properties REIT, and it's trading at its high, and if there's any chance of it on the upside. Thank you.
Thank you.
Yeah, so Northwest Health is a global medical office REIT. They own both medical office buildings as well as hospitals globally. Competent management, good niche sector that they operate in. They recently issued equity, $11.80, so that kind of caps the upside, just to answer that question. We think anytime a REIT or a real estate company issues equity, that's a view of for management in terms of what they think their net asset value is, and I think that's probably a fair statement for NWH. The risk here, I always like to caution people, is they're investing globally. You take on a lot of currency risk when you invest in this company. They have investments in South America, for example, and they don't hedge the currency. So besides taking real estate bet, you also have to take a bit of a currency bet.
Okay, thank you, Andrew. Let's go over to Lyndon, Manitoba. I don't think we've ever taken a call from Lyndon. Let's bring in Silver. Hi, Silver.
Hi. Calling about Realty Income. Just wondering your thoughts on a good entry point and where do you see the stock going in the next 2 to 5 years? Thank you.
Thank you.
Yeah, so Realty Income, this is actually one of the largest REITs in the United States.
Yeah.
I had the opportunity to meet with them actually a month ago. And
what do you think?
They're actually doing some interesting things for a company that's this large. They operate in the net lease space. Again, they have very long-term leases and where they typically rent out to a Walgreens drugstore, et cetera. They've been trying to branch out because of their size, and they've gone abroad, and they've made an interesting investment in the UK in the grocery space. So whereas this company got too big that they couldn't grow, they now have shown that they have the ability now to have above average same-store NOI growth, which for a net lease company is compelling. So if your viewer owns this, it's something I would continue to hold.
I'm curious, I know you touched on Europe earlier via one of our viewers' phone calls, but is that looking like a sexy space to you now? The fact that, a lot of the folks that sit in your chair will say, man, it's oversold, the whole Brexit drama, everything that's happening with the bond yields, especially in Germany. Is that an oversold situation now? Is it time to get in? Are you looking at that a bit more closely, or do you just focus on North America?
No, we invest globally.
Yeah.
A great example is most recently DRG, Dream Global REIT, Canadian listed REIT that owns European properties, announced it was going to be the subject of a takeover. Maybe that's a call on the European markets at this point. I tend to agree. There's too many risks on the horizon. It all depends on the asset class, however. That happens to be an office. We're bulls on the industrial warehouse space, so globally we like it. In fact, I'd say the opposite. In Europe, it's probably the most attractive area globally for industrial today. We own a name like Granite. They have exposure to Europe.
Okay, that's coming up, so don't give it away, All right, that'll be part of his top pick segment. In the meantime, let's get back to the phones. Let's bring in Jim from Saskatoon. Hi, Jim.
Hi, I'd be interested in your opinion on Slate Retail REIT, SRT.UN.
Okay, thank you.
Yeah, so Slate, externally managed company, very good operators in terms of what they do. This company operates in the United States. They own retail centers in secondary markets. So there are two things working against it from our perspective. We're not bullish on the retail sector. And if you are going to invest in the retail sector, perhaps secondary markets are not where you want to invest. As a result, the stock has been under pressure, and it's a name that we tend to avoid.
Okay, let's see if you like this next one. We'll bring in Martin. Talked a little bit about Montreal. Let's head there now. Hey, Martin.
Yes, I bought Store Capital Corporation, STOR, 2 years ago at $24. And the question is, should I continue to hold? I'm getting a dividend of 3.5%.
Yeah, and it's trading at $40, so well done there on both fronts.
Yeah, absolutely, well done. That was a name we actually used to own as well. We don't own it any longer. This, just like Realty Income, operates in the net lease space. Very competent management. We like them a lot, hence we own the stock. Today, you have, whereas I said before, you don't have to take a view on interest rates about supply and demand. This space is the most correlated to interest rates because of the longer-term leases.
Okay.
So sitting here today, you want to have a bit of a view on where interest rates are going. For the time being, I don't think they're going higher. As a result, Store seems to, certainly that 3% yield is safe. And in terms of the value from here, this sector, it trades at a material premium to its net asset value. Hence, it's able to grow accretively. So I'm very comfortable owning this stock today.
Okay, thank you, Andrew. Let's head over to Scarborough, Ontario, and Bob. Hi, Bob.
Yes, hello. I'd like to hear your guest opinion analysis on H&R REIT. Thanks very much.
Thank you. This is an interesting one, especially given the whole, I don't want to say debacle, but the whole issue with in Canada, they've got a long-term lease that I understand. H&R, do they run the Bow building? Is that
correct?
Right?
Yeah,
okay.
They built and run it, and that was a subject for them 10 years ago when it was under construction during the financial crisis, and they needed financing on it. Today, it's back in the picture because their largest tenant, as we know, has moved away. The good thing for H&R, it's a long-term lease. That's not going to be an issue for cash flow. What it means for the sentiment, however, these are stocks, is something different. unfortunately, the sectors that they operate have been pretty difficult. They operate in retail. 30% of the portfolio is invested in malls. They bought a company called Primaris. So they're diversified REIT where they have a bunch of issues in terms of the sentiment, people's views on that real estate. That said, the distribution is very safe. At this point, we're not too concerned about the short-term impacts, for example, in Canada moving out. So if I own this, I'd continue probably to hold it.
Quickly give us some color, if you will, on sentiment, though. What does that say to other corporations that are watching in Canada, which has made it very clear that this is an in Canada story. This is not, a call on anything else, i.e. political or otherwise. But what does that say to other corporations that perhaps are already doing business in Calgary or were thinking of going there?
Well, the best thing Alberta can do is try and attract industries outside of oil and gas. I think that's obvious. And they have been doing a better job in doing that in terms of cultivating like an AI industry, for example. The more incentives that can be pro-business for Alberta, the better that can help diversify that economy. And on the margin, we've seen it at least on the multifamily side. There are more people moving to Alberta this year, and they're typically taking more of the service jobs, and we're hoping to see better jobs line up for them in the future. But from a sentiment perspective, it's not a positive.
Okay. All right. We'll leave it there. Thank you, Andrew. Earlier, we did discuss the Artis REIT. On a programming note, we want to let you know Armin Martins, the CEO of the company, of the REIT, will be on the close tomorrow, 3:30 Eastern, 12:30 Pacific time, to discuss earnings and the REIT's outlook. Let's take a break and come back with Andrew's first top picks ever. Welcome back. We are with Andrew Moffs. Top picks time. You mentioned this REIT pretty much at the top of the show, BSR.
Yep. So first of all, BSR REIT, in a sector we like, apartments.
Right.
In a geography we like, the U.S. Sunbelt, 50% of the NOI coming from the state of Texas. And then a segment within apartments, affordable. We think of it as almost as workforce housing, $800 to $900 rents. Very defensive. If you think we're later in the cycle, this is a great way to invest. Being defensive, everyone needs a place to live. We look at management. Management is highly aligned, very strong. I've toured every one of their buildings. They are very adept at operating. Then we look at the valuation. There's been a number of these in the past. Names, REITs that trade on the Toronto Stock Exchange, yet invest exclusively in U.S. assets. There tends to be an arbitrage, and there's one that exists here today. If you look at the valuation of this company, it trades at about an implied cap rate of 6.3, 6.4. I challenge anyone to buy an apartment in the U.S. Sunbelt at anything north of a 5% cap rate. You apply those metrics to the company, there's 30% upside.
Okay, let's get to, I don't want to use the word a niche REIT, because a lot of REITs for the most part, do have their own niche, right? But Americold Realty, this is an interesting play. Cold is the ticker, aptly named on NYSE. So this is what? Temperature controlled warehouses. So that's taking warehouses. That's doing a deep dive.
Yes, absolutely.
Yeah.
Highly specialized, mission critical. They are an integral part of the food supply chain. They're the largest publicly traded refrigerated warehouse company. And you think of the trends today. We all want fresh food.
Right.
I was listening to Mike Medline from Empire, who runs Sobeys. Where does he see the highest growth in his business? The outskirts of the store, the fresh food, the frozen in the grocery, as opposed to the middle of the store. As a result, there's lots of high demand for their space. We have population growth across North America. At the same time, no new supply. So effectively, there's a moat around this business. It's hard to find businesses that are a moat. In real estate, that is very rare. And yet, this company trades at the same multiples as industrial warehouse, though it has double the growth.
All right, moats are always a good thing. I'm just curious. I don't want to go down a rabbit hole here, but even medical supplies. I know they're not in that right now, but is that potentially something that they could? They already have their moat, but could that be something else that they could also branch into? Because that's highly specialized, and a lot of those, medicinal ingredients that you need, supplies, need to have a certain temperature control, right?
Absolutely. I mean, the key to this business is every time they touch
growth.
and every time they touch the product, they make money.
Wow.
So if you deliver potatoes, they will take them. As soon as they take them, they get paid. As soon as they flash freeze them, they get paid. I don't know what the margins are in medical supplies, but if they can find a way, I'm sure they would do it.
All right, let's wrap this up with Granite REIT as your third top pick.
Yeah, so the industrial space, I've talked about why I like it so much. Granite, first of all, management team is top notch. Kevin Gorey is the CEO. In his previous to Granite, he was the CEO of Pure Industrial REIT, which was a core position for us at Vision. He's very adept at creating value. What's great about Granite is they have a pristine balance sheet. They have the ability now to go on offense in a market where you want to be acquiring industrial real estate because the growth is so compelling. What we like about Granite is that they also have exposure to Europe, which I mentioned before, and they've done a great job of reducing the tenant concentration to Magna, which was previously a majority tenant of theirs, is now below 50%. We actually see value in the Magna leases that they have. You put it all together, this is an industrial REIT trading with an implied cap rate in the 6s in a world where industrial today is trading in the 4s. So a lot of upside in the stock.
All right. Before we let you go, I don't know if we can throw up the Dow Jones Industrial Average. We are seeing a bit of a positive uptick on the markets. You want to give us 5 to 10 seconds on what we're seeing, which is largely, I think, due to trade optimism right now?
Yeah, the market's moving on sentiment. Daily, it's all about what's happening with China. And today, the news is good, so we'll see what tomorrow brings.
All right. Andrew, thank you so much for joining us here on Market Call. Look forward to seeing you back, perhaps in January. That'll do it for me. I will see you tomorrow. Andy Bell's doing the morning show for Paul Bagnall. We'll see you tonight at 6 o'clock Eastern. Take it easy and good luck in the markets.